Hello and welcome back to my channel, The Millions Investor, your one-stop shop for all things investing and personal finance. Investing in the stock market can be a daunting task for beginner investors, but it can also be a smart financial decision for those looking to grow their wealth over time. One of the most popular ways to invest in the stock market is by investing in the S&P 500, which is a benchmark index that tracks the performance of 500 large-cap US stocks. In this video, we will explore what the S&P 500 is, why investors should consider investing in it, and how beginner investors can go about starting. We will also provide real-world examples of historic returns and how an investment in the S&P 500 could potentially grow over time. So without further ado, let's jump straight in. What is the S&P 500? Well, the S&P 500, or the Standard & Poor's 500, as it's known by its longer name, is a stock market index that measures the performance of 500 of the largest publicly traded companies in the United States. The companies included in the index are chosen by the S&P Dow Jones indices based upon their market capitalization, liquidity, and sector balance. The S&P 500 index is often used as a benchmark for the overall performance of the US stock market. The index is widely considered to be a good indicator of the health of the US economy, as it includes companies from a wide range of sectors including technology, healthcare, finance and consumer goods. As I mentioned, the companies included in the index are weighted based upon their market capitalization, meaning that the largest companies in the index have a greater impact on the index's performance than smaller companies. This means that the performance of the index is heavily influenced by a few key companies, such as Apple, Microsoft, Amazon and Facebook. The S&P 500 index is calculated and published by S&P Dow Jones Indices, a division of S&P Global. The index is widely used as a benchmark for the US stock market, and many mutual funds and exchange-traded funds track the performance of this index. Overall, the S&P 500 is a widely recognized and closely watched index that provides investors with a snapshot of the performance of the largest companies in the US stock market. Its broad diversification and relatively stable history make it a popular investment option for both beginner and experienced investors. Investing in the S&P 500 can be a smart choice for a number of reasons. Here are some of these reasons why you might want to consider investing in the index. Diversification. One of the primary benefits of investing in the S&P 500 is diversification. By investing in a basket of 500 different stocks, you spread your risk across a wide range of companies and industries. This can help to maximize the impact of any one company or sector performing poorly. The S&P 500 is also a good example of market diversification, as it includes companies from a range of sectors including technology, healthcare, finance and consumer goods. Secondly, long-term returns. Historically, the S&P 500 has delivered strong long-term returns for investors. While there have been periods of volatility and market downturns, the index has historically recovered and continued to deliver strong returns over the long term. According to data from S&P Dow Jones Indices, the average annual return for the S&P 500 from 1926 to 2020 was 10.2%. Thirdly, low fees. Investing in the S&P 500 can also be relatively affordable. Many index funds and exchange-traded funds that track the S&P 500 have low fees, meaning that investors can keep more of their returns. Some funds have expense ratios as low as 0.03%, which is significantly lower than the fees associated with actively managed funds. Number 4, convenience. Investing in the S&P 500 is also convenient. Many brokerage accounts allow investors to purchase shares of an S&P 500 ETF or index fund with just a few clicks, making it easy for investors to add this to the index to their portfolio. Many investors choose to hold a proportion of their portfolio in an S&P 500 index fund or ETF as a way to diversify their holdings. And number 5, historical performance. As we mentioned, the S&P has a long history of strong performance. While past performance is not a guarantee of future results, the index has historically been a reliable performer over the long term. For example, between 1957 and 2018, the S&P 500 had a positive return in 53 out of 62 years. or about 85% of the time. Of course, like any investment, there are risks associated with investing in the S&P 500. While the index has historically delivered strong returns over the long term, there has also been periods of volatility and market downturns. Investors should be prepared to hold their investments for the long term and weather short-term fluctuations in the market. Additionally, whilst broadly diversified, the S&P 500 is heavily weighted towards certain sectors. This means that the performance of their index can be heavily influenced by a few key companies, such as Apple, Microsoft, Amazon, and Facebook across the tech sector. If these companies experience significant declines in their stock prices, it could impact the performance of the index as a whole. Investing in the S&P 500 can therefore be a smart choice for investors looking for broad market exposure, long-term returns, and low fees. However, investors should carefully consider their investment goals and risk tolerance before investing in any index fund or ETF, and be prepared to wait out any downturn. The historic returns of the S&P, as I've already mentioned, are incredibly impressive. According to data from Y-Charts, the average annual return of the S&P 500 over the past 10 years has been 15.9%, while the average annual return over the past 20 years has been 7.6%. Over the past 30 years, the average annual return has been 9.9%, and the past 50 years, it has been 7.3%. It is important, as I've already mentioned, to note that these returns are not guaranteed, and there is always a risk of loss when investing in the stock market. However, historic returns can provide investors with an idea of the potential long-term growth that they may be able to achieve by investing in the S&P 500. There are a variety of platforms that allow you to invest in the S&P 500. The first one being Hargreaves Lansdown. Hargreaves Lansdown is a UK-based investment platform that provides a range of investment products and services to individual investors. The company was founded in 1981 and is headquartered in Bristol, in England. The company offers a range of investment products, including individual stocks and shares, ETFs, investment trusts, and funds. The company's investment platform is designed to be user-friendly and easy to navigate, with a range of tools and resources to help investors make informed decisions. Overall, Hargreaves Lansdown is a well-regarded investment platform that provides a range of investment products and services. The company's focus on customer service and educational resources make it an attraction option for investors. There's also the option to invest in the S&P 500 through companies such as AJ Bell, another UK-based investment platform, or Vanguard, which is an investment company that was founded in 1975 by Jack Bogle. I'll make a video on these investment platforms and the fors and against of each in the next few weeks. Watch this space for more. Now, let's take a look at an example of how an investment in the S&P 500 could potentially grow over time. Suppose an investor invests $1,000 in an S&P 500 index fund today and holds the investment for 10, 20, 30 and 50 years respectively. Assuming an average annual return of 7.3%, which is the average annual return of the S&P 500 over the past 50 years, here's how the investment could potentially grow. After 10 years, the initial investment of $1,000 could potentially grow to $2,367. This assumes that the investor does not contribute any additional funds to the investment. After 20 years, the initial investment could potentially grow to $5,596, assuming no additional contributions. After 30 years, the initial investment could potentially grow to $13,190, again, assuming no additional contributions. And after 50 years, the initial investment could potentially grow to an impressive $74,082. It is important to note these calculations are based on past performance, and there is no guarantee that the S&P 500 will continue to perform at the same rate in the future. Additionally, these calculations assume that the investor does not make any contributions to the investment, which in reality is highly unlikely. So now that we've discussed the benefits of investing in the S&P 500 and provided examples of potential returns, let's talk about how beginner investors can go about investing in the S&P 500. Step number 1. Choose a brokerage account. The first step is to choose a brokerage account that allows you to invest in the S&P 500. There are many options available, some of which I discussed earlier, including online brokerages, traditional brokerages, and robo-advisors. Keep a lookout for the video I mentioned I'd do earlier. That will be out in the next few weeks. Number 2, open an account. Once you've chosen a brokerage, you'll need to open an account. This typically involves providing personal information and funding your account with an initial startup amount. This can be anywhere between $100 and $500 is what I've found in my experience. Step number 3, choose an S&P index fund or ETF. Once your account is funded, you'll need to choose which index fund or ETF you're going to invest in. There are many options available, and it's important to research the fees and the performance of each option before making a decision. Take a look at the Vanguard website and their S&P 500 fund. This is the one that I typically invest in, and where I learned a lot more about what the fund is, where the funds are invested, and how best to make a start. Step number 4, make your investment. Once you've chosen an index, simply go ahead and make that investment. This typically involves selecting the fund and the amount you want to invest and placing the order through your brokerage. And finally, step number 5, monitor your investment. It's important to monitor your investment over time and to periodically rebalance your portfolio to ensure that it remains diversified and aligned with your investment goals. However, if you're in it for the long term, try to avoid checking this daily. I find monthly or even quarterly is quite sufficient and stops me getting so obsessed with checking it daily and worrying about the volatility of the market in the short term. So in conclusion, investing in the S&P 500 can be a smart financial decision for beginner investors who are looking to grow their wealth over time. By gaining exposure to a wide range of large cap US stocks, investors can reduce portfolio risk and potentially achieve significant long-term growth. While there are risks associated with investing in the stock market, historic returns of the S&P 500 have been impressive. Individuals who are willing to hold their investment for the long term and monitor their portfolio over time may be able to achieve significant growth. By following the steps outlined in this video, beginner investors can go about investing in the S&P 500 in a smart and informed way and potentially achieve their financial goals. And once again, that's it. Thank you so much for watching. I've been the Midlands Investor. Don't forget to like and subscribe if you enjoyed this content. It really helps out the channel, and I'll see you again next time.